Hello and welcome back to Core Finance. I'm Matt Brown. It gives me great pleasure to introduce back onto the show Shaun Richards from Not a Yes Man Economics. Good day to you, Shaun. Thank you so much for coming in.
Pleasure.
We're going to talk about UK inflation and what that will mean for the Bank of England going forward. So what's your take on the latest inflation numbers?
Well, there's various thoughts here. If we just start with the basic set yesterday, we look at some of the technicals here. It's very embarrassing for the Office of National Statistics. They've brought out a new inflation number, which they say includes, they put an H for housing, they mean only occupied housing, except they use a fantasy number in this called imputed rentals for the housing thing. So there's something, money that people don't actually receive, they assume that they do. That led the inflation number to be 2.8%, but everyone ignored that and declared the 3% number everywhere you go round, be it the Financial Times, BBC, whatever, presented that. So there's an issue there. If we go deeper into the UK inflation numbers as well, though, there's various other issues, like, for instance, the various measures of the retail price index are around 4%. Now, again, our statisticians are desperately trying to rubbish that number, in spite of the fact that they're on very weak ground themselves with the one they're trying to push. But my point is here, there is a spread of data. This poses a real question, though, for the Bank of England, if we move on from that, because you see, so much of this it created. If we look back to last summer when it was promising what it called muscular monetary easing, its chief economist with a sledgehammer, whatever way you want to put that, those are part of the factors which pushed the pound down, which according to the Governor of the Bank of England yesterday is the sole cause of inflation. Now, actually he's wrong on that point, but as a principle it is true, it's a major factor in it. And so now they left themselves into quite a mess. So it would mean admitting a mistake to redo it. And then also there's a deeper question. Should interest rates be at 0.25%? No. Should they be higher, in my view? Yes. However, would I do it now? This is the timing issue. Not really, because if you come to the point of why now, what's really changed that would make you do that? And nothing particularly. I mean, if we look back to last year when they actually cut, the economy was doing quite well. Yes. Whereas now it's a bit slower. So we're in a scenario where many of the measures, ironically, would show them cutting. So here's the real problem for the Bank of England. It's not, what was it? It's the Bananarama song, isn't it? It ain't what you do, it's the way that you do it, if you remember from that in the past.
And that's what gets results.
Exactly. Well, they've got this the wrong way round, completely.
And looking at, obviously, the inflation data, looking at Brexit, does it put the Bank of England in a position where they could say, well, actually, we don't really want to raise rates. We're aware of Brexit negotiations, the issues that may cause, and that may cause a drop in inflation potentially. So why at this point raise interest rates when looking at the headwinds there could be further issues?
Well, exactly. There's so much logic here, and one of the crucial pieces of sort of economic theory that they're doing this, and I call this ivory tower thinking, and this does work because the new member, the Bank of England Committee, Silvana Tembray, I hope I've got her name right, apologies if I haven't, yesterday exampled this purely. They got her straight out of an ivory tower, and what does she sit there and say? The output gap. Well, if the UK's got an output gap, why aren't wages growing faster, and so on. So there's if the output gap has shrunk in the way that they argue, why are we like this?
Yes.
In the past, they presented unemployment at 7% as some sort of, if not threshold, a significant level. Now it's only a bit over 4%. So they're in quite a mess here in the way that they're trying to apply this and out of phase. And as you say, if you look forward 2 years, well, where will inflation be then?
Exactly. And also, as you said at the start of the interview, the Bank of England have potentially caused some of this in inflation by quantitative easing, sledgehammer, muscular approach. But it's taken quite a few months to actually feed through the system. So it goes to show that interest rates, when you do have a move, be it up or down, can take time to actually feed through.
Yes, there always was debate over, and there still is ongoing in some respects, as to what the timing for QE is when it has an impact. And if we look at interest rates, the argument was that somewhere around 18 months after was approximately, you'd get most of it, if not all of it, which has not worked too badly if you look at the fact it was last August. Now we're running forward a year and a bit beyond that, we're seeing it. So that has kind of worked, I think, and suggests maybe the QE timing isn't that different either.
And finally, so a rate hike in November. Yes, no, is it nailed on? Carney seems to have jawboned the market into thinking it will be the case.
He's certainly giving the impression it's nailed on. I've still got a lot of doubts about that. The unreliable boyfriend could be unreliable one more time.
Indeed, continues cheating. But like you say, banana arm song ain't what you do,
It's the way they do it.
Fantastic. Shaun, thank you for joining us today.